All right, welcome to Chapter 4 and 5, the video lecture series. Chapter 4 is all about what's in gross income. Chapter 5 is all about what's excluded from gross income. So let's get started. So when we think about gross income from a tax rule perspective, there are three conditions that you really need to meet. The first is there must be an economic benefit. So you can think about, for example, when you borrow money, is that income? Because suddenly you're better off, but of course you also have an offsetting liability. So generally speaking, debt is not considered income. That's especially true, of course, if it's from the bank. If, on the other hand, you get a loan from your mom, like, hey, mom, can I borrow $10? The actual reality of whether there's a liability there might be more in question. So you might argue that you do have an economic benefit in that case. The second thing that needs to happen is a realization event. So when a transaction is complete and income can be measured objectively. I like to think of a realization event as when you've engaged in a transaction and that transaction has resulted in a measurable change in property rights. So when you sell something, clearly there's a measurable change in property rights because it used to belong to you and now belongs to someone else. And the third condition is recognition, and recognition is generally the case for almost all forms of realized income. There are a few provisions that would allow for either deferral or exclusion of those. Exclude means you never recognize, and defer means you'll recognize it at some point in the future. And we will dig in on a lot of the different tax provisions that allow deferral or exclusion for obvious reasons. Gross income can come in any form. So it can come in the form of cash or property or services. Sorry, I'm taking a drink of root beer every once in a while. So the property can come in all sorts of forms: stocks, bonds, cars, planes, trains, as I like to joke, chickens. All those things serve as property, and it comes in at its fair market value. So Mark's a lawyer. His clients make the following payments to him for services that he's rendered. So $1,000 cash, that's clearly gross income. A check for $1,000 is the same thing. So you've received a negotiable instrument that has a value of $1,000. Credit card charge for $1,000, also income, of course. A gift card, so if someone gives you a gift card worth $1,000, to pay in payment of your services, that's property and it's worth $1,000. Same chickens, right? As I mentioned, it doesn't really matter what form it comes in. Or services as well, right? So, I'll give you these legal services if you fix my car. And that's a barter transaction. You would generally take the fair market value of those services in as income. Now, a promise to pay $1,000 depends really on maybe whether that's a supportable promise to pay. So when we think about a check, in a way, a check is a promise to pay, but it's really drawn on a bank. But if someone just, wrote on the back of a napkin, I'll gladly pay you Tuesday for a hamburger today, that might not be worth the napkin that it's written on and may actually have no value. So, these promises to pay, we'll dig in a little bit as we work our way through the cash basis method for recognizing income, which is a great segue into what we talk about next. So we know, what it is, right? What is gross income? We kind of know like how it can come to us. And this question is about when. When do you recognize, the gross income? There are two basic methods to follow: the cash method, a cash basis taxpayer, and accrual basis taxpayer. We'll start with the cash method. Almost all individuals use the cash method because they don't keep books and records. And so as a result, they're not prepared to use the accrual method. Some taxpayers have businesses that use the accrual method, but the taxpayer themselves probably on a cash basis. In any event, constructive receipt is the rule, and constructive receipt is think of it like a precondition to actual receipt, meaning you can constructively receive something without having actually received that same thing. The general rule is income, although not actually reduced to a taxpayer's possession, is constructively received when it is credited to the account set apart or otherwise made available so that the taxpayer can draw upon it at any time, or that the taxpayer could have drawn upon it during the taxable year. Sorry, it's late and I'm recording videos. If notice of intention to withdraw had been given. So this really means it doesn't have to actually be received by him. It could be like, oh no, it's in an escrow account of some sort and it's yours the second you go ask for it. Well, in that case, you're in control and it's constructively received. However, income is not constructively received if the taxpayer's control is subject to substantial limitation or restriction. And we'll talk about some examples of what might rise to a substantial limitation. So Colbert gets a check from a customer Friday, December 31 at 11 a.m., sticks it in a drawer to deposit next year. And if you're in my 503 class, we use these exact same examples because gross income is gross income is gross income under the tax code, kind of no matter what kind of tax-paying entity you are. Under the cash method, it's the cash method. So anyway, gets a check at 11 a.m., sticks it in a drawer to deposit next year. And the question is that constructively received? The answer is almost certainly yes, right? So receive the check is choosing not to deposit it. The way the rules are written, you really can't turn your back on income. And so as a result, that is constructively received during the year. In fact, in this case, it's actually received. So in this case, gets a check from a customer Friday, December 31st at 3 p.m., but already made the daily deposit. It's like, oh, I don't feel like going to the bank again. So I'll stick it in the safe and I'll take care of it next year when we open back up on the 2nd. This is still constructively received. Again, it's actually received. So there's no constructive receipt about it. There's no limitations other than ones he's imposed on himself. And again, that's not a substantial limitation because you can't turn your back on the income. In this case, gets a check last day of the year at 5:30. The bank is closed, and so he sticks it in the safe to deposit next year. Is that constructive receipt? The answer is yes. That is also still constructive receipt. So he's received something of value. You know, a check is a negotiable instrument that you can draw on the payer's bank, right? Pay to the order of. And, it's got the bank on it. And, for the most part, the bank's going to allow that to be negotiated. And you say, well, the bank's closed. Well, that's true, but you could, endorse it over to someone else. You could take it to a check cashing place and, convert it that way. So there's still things that can be done. That piece of paper has value, and generally has the value that's written on it. So, that's still constructive receipt. So in this case, gets the check at 5:30. It's during the party, and frankly, he's having a good time, doesn't want to leave, and puts it in the safe. Doesn't matter, right? Same situation, still constructive receipt. This case gets the check, so the customer drops by quite late on the last day of the year, 11, during the New Year's Eve party, and he's just hammered. He's hammered drunk and loses the check. Realizes that it's missing weeks later and then requests a replacement. So there's no doubt there's a limitation here. But the question is it substantial? And the courts have found no, this is not a substantial limitation. Again, the reality is you can't really turn your back on the money. And to allow that to happen allows a taxpayer to turn their back on it. Gets a check last day of the year, 11 a.m., so back in normal hours. No one's hammered, but the check is post-dated to January 3rd. What do you think? Constructive receipt or not? Well, amazingly, the answer is this is also constructively received. So to really figure out how this works, you need to know a little bit about the banking system. But the reality is the bank can still negotiate a check even if it's post-dated. So if I write a check to someone and I post-date it and they go ahead and turn it into the bank can go ahead and negotiate that against my account immediately, in spite of the fact that it has a different date on it. And that's just the case. Now, if you take it to a teller, the teller might be like, oh, this check isn't ready yet, and may say you need to come back on the date. But they're not required to do so under banking law. And the last one is the same situation that we just went through, except this time the customer says don't deposit it until January 3rd because they don't have enough money to cover it. And this represents a true substantial limitation, because what happens is that check is a piece of paper, right? And if there is no money to back it, and you're aware of that, then what's happened is you've reduced the value of that paper to nothing but the paper itself. It's no longer a negotiable instrument, because if it's presented at the bank will not honor it because there's no money in the account. Okay. So who can use the cash basis method? Just about everyone, except C corporations or a partnership with a C corporation as a partner. There are some exceptions. Farming corporations and qualified personal service corps can still use the cash method. And starting in 2018, there's a gross receipts test where you measure the gross receipts for the 3 previous years. And if it's less than 26 million, which is adjusted by inflation each year, but only in increments of $1 million, then you can, even if you're a C Corp, you can still use the cash basis method. So that was a big expansion of who could use it at the end of 2017 to allow small businesses to use the cash method if they so choose. Okay, well, the other method is the accrual-based method. So, and again, we're talking about income because this is an income chapter. When we talk about deductions, there are rules for each of these for deductions as well. But for income, an accrual-based taxpayer recognizes the income when all the events have occurred, which fix the right to receive the income, and the amount can be determined with reasonable accuracy. So there is a 2-pronged test, the all events test, for accrual-based. And I think most people can establish what it means to determine something with reasonable accuracy. It's just, what does it mean when all the events have occurred which fix the right to receive income? So the courts had to come along and, in a case called Schlude, help define what that means. And the Supreme Court said, oh, well, all the events have occurred to fix the right to receive such income when the earliest of these 3 things happen. 1, the income is earned. So think of that as, when the revenue cycle has closed on that item, right? And that really follows kind of book accounting for the most part, is when have you earned the revenue? And most transactions, frankly, are subject to that. But there are a couple that might be outside of that. And you can bundle these together. The payment is due or the payment is received. And so if you've received a payment, even if you haven't provided the services yet, under the all events test, that's income. And that creates kind of a matching disaster because, I tell you what, let's just do an example and I'll show you why it's a matching disaster. So let's say you buy a Cheesecake Factory gift card for your friend back in 2020 for the holidays. And you give it to him, but your friend doesn't go to the Cheesecake Factory for 2 more years because, as you know, the Cheesecake Factory menu is about 100 pages long. And so first they had to read the novel, and then they had to listen to the audiobook, and finally they get through the Cheesecake Factory menu and they say, okay, I'm ready to go. So what does the Cheesecake Factory's book accounting look like in 2020? Well, they debit cash, right, because they've received the cash for the gift card that you bought, and they credit deferred or unearned revenue, right? That's a liability account. Hopefully you know enough about your accounting to know what that deferred revenue is all about, right? So there's a liability. What's the liability? That they agree to provide services at some point in the future should someone present that card. In 2021, there's no accounting for this at all because nothing happens. But then in 2022, when your friend goes to the Cheesecake Factory, well, now the earning cycle is complete, right? Because they presented the card. So they're going to release that unearned revenue into revenue. So debit unearned revenue, credit revenue. And at the same time, they would also book the cost of goods sold that's associated with the revenue, right? You presented the card, you ate your meal. So they, get rid of the cost of the cheesecake or whatever it might be that you bought. So under the all events test, that works entirely differently, right? Because under the all events, you are required to recognize the income at the earlier of, and in this case, it's the cash was received, right? You received the payment. And so that would say that in 2020, you debit cash and you directly credit revenue. There's no deferred or unearned revenue account. Then in 2022, when your friend presents the gift card, the Cheesecake Factory at that point gets to debit cost of goods sold and, get rid of inventory or, again, whatever their cost structure is for the item. And that presents terrible matching, right? Because typically you want to match revenues with expenses. Now, that's a GAAP accounting rule, right? It's not a tax rule necessarily, but even the tax folks admitted that was probably not the best way to work. And so they've provided an option for deferring. And this is really specifically meant to address the poor matching that the all events test requires. And this happens under Section 451C. And it says you can defer an advance payment for up to 1 year with a couple qualifications. The first is you must always recognize it no later than it's recognized in your applicable financial statements or your books and records. So basically, if you recognize it for book purposes, you also are required to recognize it for tax purposes. You can always elect to recognize it under the all events test if you prefer. So if you want to do that bad matching and recognize the income early, they'll always let you do that. Okay. So on November 1st, Arnold receives $4,800 in advance payments for a 1-year contract to provide up to 48 dance lessons. So since he starts in November, he's going to give 8. So think of it as about a lesson per week, right? I mean, it's 48. So, he takes a couple holidays here and there. In any event, he gives 8 lessons in 2021 and then the remaining 40 in 2022. So in 2021, he's going to recognize 1/6 of the revenue for his books, right? So that's 8 out of 48. And for tax purposes, he's going to choose to defer. So how much would he have to recognize for tax purposes in 2021 and 22? So in 2021, he'd like to defer, but you can never defer beyond what you've done for financial statements. So that same 8 times $100 a lesson that he recognized for books in 2021, he's also going to recognize for tax. In 2022, he would recognize the entire remaining deferral, which is the 40 lessons times 100 or $4,000. If we contrast that with instead he's doing 96 lessons over 2 years. So I think the slides I posted for you say 3, but it's 2 years. He's going to recognize 1/12 in 2021. So that's, 8 lessons still out of 96. And then he's going to do 48 lessons, right, in 2022. And then the remaining lessons, another 40 lessons in 2023. And he gets to recognize that, right? He'll book it as debit cash, credit deferred revenue. And in every lesson, he'll release $100 worth of that deferred revenue. But how about for tax purposes? So again, you can never be later than you are for book purposes. So in 2021, he'll recognize that same 1/12. Right. But in 2022, the tax rule says you can never defer beyond the end of the year after the year in which you receive payment. So he got the payment in 2021. That means he needs to recognize all of the rest of the advance payment in 2022. So he's actually going to recognize the remaining 11/12 of that contract in 2022. And then for tax purposes in 2023, there's nothing to recognize. He's already recognized all 12/12. So, when he recognizes it for book purposes in 2023, he will not recognize that same amount for tax purposes. So there are exceptions to the all events test, prepaid interest and prepaid rent. Those are the big differences from an income perspective. If you receive prepaid interest, you recognize it in income. And if you receive prepaid rent, it is income when it's received. So there's no deferral permitted for either of those. Okay. So now what happens is we kind of busted through the timing. And what we're left with is, okay, well, we kind of know the timing rules. We have a vague idea that gross income is just about everything on earth. So let's go through and talk about some specific types of income, right? Some types of income that you may or may not assume are income, but just to be sure. And the first one is income from personal services. So we think of this as being called compensation, wages, salary, whatever it might be. So this is a transfer of value from an employer to an employee. And that's pretty much always presumed to be income. And you actually have to work pretty hard to overcome that presumption. This is true even when a child earns the income. So if you have a child who is working for some reason, even if you take their money and deposit it in your account, that it's still under kind of the assignment of income concept. That income belongs to the child, and as a result, they would need to file their own tax return potentially. Depends really on how much income it is. That raises the assignment of income doctrine, which basically says income belongs to the person who earned it, or if it comes from property, the person who owns the property. So this prevents taxpayers from willy-nilly just assigning income to other members of their family or whatever it might be to try to save on tax rates, since we have a progressive tax rate structure. So how does a taxpayer determine the amount of taxable compensation? So let's say there's a guy, Steve, he's an employee, works for the state of California. And from his employee, he gets a monthly paycheck, and his monthly paycheck includes a bunch of different stuff. So first, there's a gross salary, right? So anyone who works, you generally are paid, okay, what are your gross wages? Well, that's the total amount. But invariably, there's a lot of things withheld from your pay. And for Steve, there's a deduction for parking to pay for on-campus parking, for example. There's a $500 contribution to a 457 plan. That's a retirement savings plan. There's a $42 contribution to a medical flexible spending plan, which we'll discuss when we get to Chapter 5. Then there's a $574 contribution to the qualified pension plan. There's a $12 contribution for membership to the faculty staff club. And then there's taxes, federal income taxes withheld, state income taxes withheld, and employment taxes withheld. So you can see that, your gross salary is one thing, but of course your net pay is something entirely different. So, and then on top of that, Steve's employer, which happens to be the state of California, also pays about, just over $1,500 in medical insurance premiums for Steve, his spouse, and dependents, $169 for dental insurance for the same, $7.50 for vision insurance, $5 for long-term disability, $7.50 for some group term life, and they also make a contribution to the pension plan as well. So, Steve has some taken out of his check, but his employer also pays some on his behalf. So you got all these things that are tied up in compensation, and it can, make determining exactly what the compensation amount is a little bit difficult. The good news is the burden for this really does fall on the employer. So the employer is responsible for sending a wage and tax statement to the employee and, of course, the Internal Revenue System, the Internal Revenue Service. And so that W-2, which is the form that's used to report that information, and W-3 is a collective one, that's like one for the whole company, has that information on it. And you would see a reconciliation of that amount in box 1. So what happens is the employer goes through all these items, and payroll is aware, payroll manager knows what's taxable and what isn't, and goes through and using that information calculates the taxable amount into box 1 on the W-2. So that's where you're going to see taxable wages, salary, bonus, awards, commissions. Just about every type of taxable compensation rolls through box 1. In most instances, you just lift that number and put it directly on your Form 1040 on the wages line. If you get more than one, or you're filing with your spouse, you just add them together and report them on the wages line. So it's not like you break them up or you file two 1040s. No, you just add the amounts together, put it right on the 1040. So in some respects, the burden of determining taxable compensation, for the most part, really does fall on the employer, not the employee. And as I mentioned, makes payroll tax specialist a pretty cool job. Okay, so that's one type of income, compensation, right? It has a lot of slides just for that one type. But of course, compensation is a very important kind of income because it's the primary source for most U.S. taxpayers. Another one is income from property. So if you own the property, you generally own the income. So let's think about interest, for example. So when we think about recognizing interest income, that normally follows time, not necessarily payment. So interest is a function of the passage of time. And so a lot of times you're going to be forced to recognize interest when you've earned it as opposed to when you've received it. $10,000 bond purchased at issuance on 1/1/2021. The rate is 5%. It pays every 6 months. So, when you think about that, 5% rate on 10,000, that would mean that every 6 months, you're getting $2,500 worth of interest. Sorry, that's got to be $250 worth of interest, right? Yeah, it is. So, that $250 would come in. So if you just keep holding it, eventually it's going to pay $250 every 6 months till it matures, and then they're going to give you $10,000 back. But what if you decide to sell that bond between interest payments? So what happens is, the bond makes an interest payment to whoever owns it on some date, right? Some declaration date, for lack of a better term. And so if you sell it before that date, then you're never going to receive your interest. So the way the bond market works is basically you demand your share of the interest from the person that's buying it from you. So let's say that, with this particular bond, you're going to sell it and the trade's going to settle on the same day, which is February 28th. Well, that means you're due 59 days worth of interest. So what that means is you're going to require the buyer to pay you that accrued interest. And so rather than paying you $10,000 for the bond, they're going to pay you $10,000, $10,080.82 because they're going to pay you the interest that you deserve because they're going to get all $250. But the market value of that bond can also fluctuate due to changes in underlying interest rates. So the bond was issued at par when interest rates were 5, but now rates for similar bonds have decreased to 4%. So the question is, would you rather have a bond that pays 4% or 5%? And of course, most people would rather have a higher return. And so they'd rather have a 5% bond than a 4% bond. But you know this, right? You know the prevailing market rate is 4%. And so you're going to demand a premium for someone to buy that bond from you. That's called market premium. There's market discount when interest rates go the other way. So market premium, market discount. So what would happen is the bond's price would go up. So let's say because of the 1% drop in interest rates, that 5% bond, because it pays higher than prevailing rates, is worth $11,025. And you sell it, of course, for that $11,025 plus your share of the interest, which it's going to pay, right? The 5% coupon, which is that same $80.82. So now the buyer's got to pay you $11,105.82, the total of kind of the bond's face value plus the premium plus the interest that's accrued. So now the sale would be a little more complex. And this is something that often gets missed when people are trading in fixed income is there's probably an interest element and there's probably also a capital gain element to the sale of that bond. And so in this case, you sell it for $11,105.82. Your basis in the bond is the $10,000 you paid for it. That difference is $11,05.82, but then you back out the interest income that you need to recognize separately, leaving the capital gain of $1,025. And that $1,025 is how we got to $11,025 here, right? That was the amount of gain in the value of the bond because of fluctuating interest rates. That's recognized as capital gain. That's not recognized as interest. Later on, when we talk about market discount and premium amortization, what you'll see is that you actually start to recover that ratably over time. Um, and so, but that, of course, requires that you hold the bond. Okay, how about stock? We talked about bonds. How does a stockholder receive income from a corporation? Well, is how's that that income allocated to shareholders? And let's say you for the year ended 12/31/2021, McDonald's generated, because I looked it up, about $7.5 billion in net income, and their EPS, which they haven't released yet, or at least I couldn't find it, probably going to be somewhere between $7 and $8 a share. As it turns out, I own 22 shares of McDonald's. So what is my share of the income and how do I report it? Well, on one hand, you might say, oh, you own 22 shares. If earnings per share is $7, then you take 22 times 7. But that's not how it works for tax purposes. Shareholders in a corporation will generally only recognize income when it is distributed to them, not just allocated to them. So also during the year, McDonald's paid 4 dividends. It paid a dividend of $1.29 per share on at the end of March, June, and September, and then it increased the dividend and paid one of $1.38 as of the last day of the year. So really, my income from this McDonald's stock is my dividends, because that's what's been distributed to me. So I'd add up my dividends, times my 22 shares for the first 3 dividend payments. So that's $85. And then I got that one more fourth quarter dividend payment for $30.36. So my total dividend income would be $115.50. Now note that because corporations are tax-paying entities, that McDonald's has already paid income tax on its earnings. In fact, their tax expense for 2021 was $1.5 billion. Now, they may or not have actually paid $1.5 billion, but at least their book expense is $1.5 billion. And so that's quite a bit of money. So this is why we have preferential rates for qualified dividends. So if we have a company that has a corporation that has a profit of $100 and there are no preferential rates at all, then the tax rate on a corporation is 21%. So they'll pay 21% corporate taxes. That only leaves $79 left to distribute as a dividend. If the tax rate on dividends was the ordinary rate, right? So, and I chose the highest marginal tax rate taxpayer, the dividend tax would be $29. So total taxes would be $50. And so the effective tax rate on that income is 50%. That's a lot of tax, considering that you chose corporate entity structure for some reason, but you're just getting hammered on taxes. So then if instead you lower the rate on dividends to 15%, which is exactly by design, then now what happens is that the $100, you pay the same corporate tax of 21, there's still 79 left over, but at least now the tax rate on dividends is 15. So that means the dividend tax is reduced to 12. Total taxes are only 33, meaning the effective tax rate is only 33%. So you can see that, this qualified dividend preferential tax rate is designed to lower the combined tax rate on corporate and individual income. And then lastly, if, of course, in the highest marginal bracket, your dividend tax is 20%. And so if we look at that calculation, corporate's still 21%, $79 left over. At 20%, that's $16 of additional tax. So the total tax is 37, and the effective tax rate is also 37%. So really what that does is it says, look, we're not intending to tax this income twice. Really, the corporate tax is a way station on its way to being distributed to its owners. And so really, we're just in a way collecting that tax early at 21% to come along later and collect the rest. But it should never be more than the highest effective tax rate on the owner themselves. Okay, so you must hold a stock for a certain number of days to get preferential rates. That's called a qualified dividend. So again, you have to have a qualified dividend to get those preferential rates we spoke about. You can compare that to an ordinary dividend, which is one that's not qualified. Now you'll see that the way we report dividends, qualified dividends are actually part of ordinary dividends. They're just a subset of the ordinary dividend. Dividends are reported on a 1099 dividend statement. Usually reports, if you look, you can see box 1A, total ordinary dividends, 1B is qualified dividends. There's another type of dividend called a cap gain distribution that we'll talk about in a little bit. And there can even be non-dividend distributions, right? Those that aren't taxable at all. So continuing with our income from property, so that was an investment in a C Corp. What if you're invested in a flow-through, like a partnership LLC, or to a lesser extent, a trust or estate? Well, these are flow-through entities. And so now income is allocated to the owners, not when it's distributed, but when it's actually recognized by the business. In this case, a distribution of that earnings is not required for the individual to pick it up. So if, for example, if we go back to my McDonald's example, if McDonald's was a partnership, my share, my 22 shares, McDonald's has about 750 million outstanding shares of stock. So that 0.000 with a whole bunch of zeros, 29, that would be my ownership share of McDonald's. If their income was $7.5 billion, then my share of that income would be $220. And that would be the case if McDonald's were a flow through, whether it pays me a single distribution penny or not, right? I'm allocated the income from a flow through. That's when I pick the income up, not necessarily when it's distributed to me. Okay, so the rule of law is that income follows property is a common law approach, right? So most of American law is based on English common law. However, there are a few states, including California, that follow some slightly different rules when it comes to whether income follows property. And that's generally called a community property state, and California is one of those. And really, it only matters when it's married filing separately, because that's the only time you have to divide income up for the most part between a married couple. But we still need to look and see what that would look like. So there are two types of property under kind of these community property state laws. There's separate property. That was property that was owned prior to the marriage or happened to be inherited while you were married. And then basically all other property is community property. So as an example, A and B are married. A has wages of $40,000, B has wages of $50,000. They have a joint savings account that's being supplied by their current earnings that they're making that earn $200 of interest income. But A also has an investment that she owned prior to marriage that has $400 of income. So what happens in a community property state is rather than giving $40,000 of wages to A and $50,000 to B, in fact, what you do is split those evenly between A and B. So A gets half of 40, B gets half of 40. A gets half of 50, B gets half of 50. With the joint savings account, that's community property because the investment was generated from community income. That $200 is also split evenly between the two spouses. However, that $400 of investment that comes from something that was owned prior to marriage, that's separate property. And so that interest would be separated and applied only to A. None of it would go to B. And again, if you're married filing joint, none of this matters. Really only matters, if you're married filing separate. Okay, gross income and divorce. So let's talk briefly about divorce. There are some nuances to this, but we certainly want to cover some of the basics. So when we think about divorce and taxes, kind of what happens when you get divorced is the first step one, divide all existing property between the two spouses. So think of it like, okay, you get the house and the car and I get the dog and kids. That's merely a division of the existing property and generally would not trigger any sort of tax impact, right? So, we're in theory going to split things up evenly. And so, you get the ski house and I'll take the beach house, that kind of thing. No tax results from just basically retitling those away from a joint ownership into ownership of, one of or the other of the ex-spouses. Step two is, are there any support payments? And there are really two kinds of support payments from a tax perspective. There's alimony and then any other kind of support besides alimony. And the reason that's unique is that pre-2019, if you were divorced before 2019, your alimony is income if you receive it, and it's deductible if you pay it. Whereas after 2019 and after, alimony is not income and not deductible. So what that means is you can still grandfather in, right? If I'm divorced in 2016, I still apply the pre-2019 rules. If, on the other hand, I'm divorced in 2019, I apply the 2019 and later rules. So child support and other support payments, if it's not alimony, never income, never deductible. Old regime, new regime, it's always been the same. Okay. So another item of gross income that you may not be familiar with is something called imputed interest. And so this is a conceptual outcome, and it's based on economics. But this particular part can be hard to follow. And naturally, you take a difficult concept and you apply complex tax rules to it. So let's start with the economics of this. If I loan you $100,000 for 10 years, you clearly have the use of that money. And that means I do not have the use of that money. Well, I should be expected to be rewarded for the loss of being able to use my money, right? First off, when you pay it back, it's going to lose some purchasing power. Secondly, I could be gaining some effective rate of return on that $10,000 if I had it to put to work for me. So the fact that you're not giving me any because I gave it to you at a 0% rate. Well, the reality is I should be charging you something, right? Some prevailing rate of interest so that I'm at least being kept whole, because as it stands now, I'm actually losing money because I'm not charging you interest for the use of my money. So I've clearly transferred something of value to you by making you a loan at 0%. And so if I've transferred something of value to you, that starts to sound like income, and it is. That's imputed interest income. Congress says there's no such thing as a free lunch. So even though that interest is not stated, it's there all the same. And therefore, a lender will need to recognize imputed interest income, and the borrower will actually have interest expense. Now, that interest expense may or may not be deductible. It depends on the type of interest. So you use this imputed interest when you make what's called a below market loan. And who decides what market is? Well, that's based on tables published by the IRS. So if you make a loan and it's below the IRS table that applies to that kind of loan, then you have an imputed interest problem and must impute interest for both the lender and the borrower. So let's say I loan my sister $100,000 for 10 years at 0% so that she can buy a house. And I do so when the applicable federal rate, so the notional rate that's applied by the IRS for a loan like this one is 2.5%. So what happens is, because I've got imputed interest, during the year, I'm going to recognize interest income of $2,500. That's the 100,000 times the applicable federal rate of 2.5. And I'll treat it as if I simultaneously gifted that same $2,500 to my sister. That's why she didn't have to pay it. So that's how they treat the economics of this, is I charge you interest, therefore I have interest income, but then I turn around and gift it right back to you. So that's called a gift loan. So my sister would have interest expense at $2,500. And since it's on her house, there's a chance that would be an itemized deduction that you would be able to deduct. But neither here nor there. The other thing that happens is she's received a $2,500 gift, of course. And so that gifts are non-taxable. And so at least in this instance, she might get to deduct it and doesn't have to pick up the gift as income to her. So let's say instead I loan my employee $10,000 for 10 years. And at this time it's 1%, right? It's not 0%. And I'm just doing this to show you that you pick up the incremental difference as income. So applicable federal rate, 2.5%. So in this case, this is called a compensation loan as opposed to a gift loan like the previous one. So this means I'm going to recognize interest income of $1,500, right? That's the 2.5% minus the 1% I am charging. So that 1.5% times 100,000 is 1,500. I'll treat that as if I simultaneously paid my employee $1,500 in compensation. So again, think of this as, from my perspective, the net effect is zero, right? I've got interest income of $1,500, but I also have a deduction of $1,500. So from the employer's perspective, it's fine. The net effect is basically zero if I ignore employment taxes. However, the employee will have interest expense of $1,500. That's probably non-deductible because she used it to pay for her kids' college. But she also picks up that $1,500 in compensation expense. So remember I said from the employer's side, they're going to treat as if they paid $1,500 in compensation and deduct that. Well, in the parity that we look for in the code, that means someone's got to pick up $1,500 in income, and sure enough, it's the person who enjoyed the the interest-free use of that money. Okay, what if I'm the corporation and I loan my shareholder $100,000? 10 years, 1%, everything else is the same. The applicable federal rate still 2.5%. So now the corporation recognized interest income of $1,500, but it simultaneously will have paid the shareholders $1,500 in dividends, right? So that's distributions made with respect to the ownership of the shares. Because those shares are owned, that's a dividend, not compensation. So as a result, they're gonna have, or the corporation is gonna have interest income of $1,500 and $1,500 in dividends paid, which by the way are not deductible. The shareholder has interest expense of $1,500. It's a pretty good chance that's non-deductible because again, it's for kids' college. But they're also going to have to treat it as if they received a $1,500 dividend. That would, of course, be taxable. So if I loan my sister, let's say just $500, and it's like one of these deals where like, hey, I'm having a rough month. Can I borrow $500? I promise to pay you back when I get paid in about 2 weeks. That seems like, wow, really? We're going to ask taxpayers to calculate imputed interest on a loan like that? And the answer is no. So there are a number of exceptions to having to do the imputed interest calculation. So the first is a gift loan of $10,000 or less, unless those proceeds are used to purchase income-producing property. So this would be like, okay, I'm going to loan my sister $10,000. Let's take that back. I'm going to loan my child $10,000. And they're just going to go out and buy the same stocks and property that I would have bought with the $10,000. Well, now they've engaged in income shifting because they purchased income-producing property. So if, on the other hand, they just pay living expenses with it or whatever it might be, now that's not income shifting, and so as a result, the gift loan would be treated as if it's no imputed interest, and we'd get away with it. If it's a gift loan between individuals of less than $100,000, imputed interest will be limited to the net investment income that's generated. So think of this as, first off, if it's a gift loan and it's $10,000 or less and it's not used to purchase income producing property, it's already excluded from the imputed interest rules. Now we're expanding that up and saying, well, actually, if it's all the way up to $100,000, you still have to calculate imputed interest, but it's limited by the amount of net investment income that the person that received that tax-free loan made. So, and then there's an exception to the exception that says, okay, well, look, if the net investment income is $1,000 or less, forget about it. Just don't worry about it. You don't have to impute any interest at all. So compensation and shareholder-related loans of $10,000 or less are free of having to do imputed interest unless they're motivated by tax avoidance, which is kind of a qualitative measure. Okay, the next form of income is annuities. So you can read the investor.gov definition of what an annuity is. And I guess what I would add to that is it's not always an insurance company. A defined benefit pension plan, for example, can also pay you an annuity. So what is an annuity? It's just a contract, right? So let's say I invest $100 and I sign a contract that says I'll get 110 back. And that's starting to feel a little bit more like debt, isn't it? In some ways, that's what debt is. Like I'm going to invest $10,000 in this bond, and what's going to happen is you're going to pay me some interest rate, whatever that is, for the next 10 years, and then you're going to give me all my money back. Well, that sounds a little bit like what we're talking about here. It's maybe nuanced differently, though. So let's say that instead I invest $100 and I sign a contract that I'll receive $13 a year for the next 10 years. Well, clearly I have a basis of 100. So the question is, as they're paying me $13 for the next 10 years, how do I recover that basis? And therefore, anything left over would be income. And so there's actually a pretty easy formula. It's right in your book. And it basically says, take the amount you've invested, divide that by your total expected return over the lifetime or the remaining lifetime of whatever it is, and then multiply that by the amount you received that year. So 100 divided by 130 multiplied by the $13 that I'm going to receive from my annuity says that I can allocate $10 of that, the basis, right? That's the excluded amount. The remaining amount, the $3 that's left over, that's just income. But what if I invest $100 and sign a contract that I'll get $13 a year, but it's going to last until I die? Well, the difference is, look, we knew how to recover basis when we had a fixed period for that annuity. Oh, it's going to be for 10 years? Got it. No problem. We just do that ratio calculation. That's the excluded amount. But we don't really know when we're going to die unless you happen to have a crystal ball or something. And so as a result, we have a hard time calculating what is our expected return. And without that, we can't determine how much do we exclude, how much do we include. And so the IRS said, oh, well, why don't we just use mortality tables, right? These are an estimate of how many years you're going to be alive. And as a result, you can use that information to calculate your expected return. So again, that was 130 in our original example. We wouldn't know exactly what it is here unless we use some of this information and tried to find the table. So these tables are published by the IRS, right? You don't get to decide how long you think you're going to live. And there's no adjustments for cigarettes or anything else like you might see on a life insurance policy. They're really just based on your age, and or they're based on you and your beneficiary's age if it's a joint annuity. So sometimes, especially a retirement-based annuity, you might say, oh, I want it to pay me $13 till I die, but then I actually want it to keep paying my wife. Now, typically it would be a lower amount, right? Because they're not, the insurance company or whoever it is doesn't want to lose their shirt on the annuity. But then instead you look at kind of the joint survivorship of both of the people on the joint annuity, not just one. So for pensions, for payments from qualified retirement plans, the annuity rules use a simplified method. And what you'll find is that the simplified method is super similar to the regular method. So step one is to determine, does the pensioner have any basis in the pension? Remember, in that last version, we went out and we bought a contract with our $10,000. Sometimes a pensioner may have basis, sometimes they may not. So typically, contributions are made by an employer on behalf of an employee. If that's the case and they're non-taxable, then you don't get any basis. You don't get any of that amount that you get recovered, that estimated recovery. None of that comes from what you put in because in theory, you didn't put anything in, right? Your employer did it on your behalf. Most contributions by an employee to a pension are pre-tax, meaning the employee is not taxed on those amounts contributed. As a result, get the same impact, right? So because the contributions were from post-tax dollars, you as the employee probably going to have to pay tax on whatever comes out. You don't have any basis. If there's no basis and the entire distribution is from the pension, it's just going to be taxable. If there is basis, then of course we need to do that same allocation that we did for the previous annuity that was purchased. We just need to allocate between basis and income. So they have this simplified method, and the way it's simplified for the most part is there's just a smaller table than the previous table. So this goes back to, like, is it really simplified? I'm not really sure, but if you're doing your tax return by hand, it probably is a little easier. So you still do that same kind of calculate that exclusion amount. The real primary difference is you just use a different table. Okay, moving on through more more forms of gross income. Prizes and awards, these are almost always taxable. So if you win a raffle, a lottery, a game show, you get, like an award from your employer for being the best salesperson. That's pretty much always taxable income. There are 3 primary exceptions. The first is the Olympic medal exception. I put it first because we're in the middle of the Olympics right now. So you do not have to pick that up as income as long as your AGI is $1 million or less. So I call that the Michael Phelps rule, right? Because that guy was making more than $1 million in endorsements. And so his Olympic prizes were in fact taxable. There's the Nobel Prize exception, and I call it the Nobel Prize, but the rules are clearly based around an award like the Nobel Prize. So as long as you don't have to provide services, you didn't self-nominate, there's a handful of restrictions, and probably the primary one is that you gave it away to a qualifying charity, then you do not have to pick that up as income. The last one is employee achievement or safety awards. And these can be excluded as long as, 1, they're not paid in a cash or a cash equivalent. So no gift cards, no cash, of course, no checks, anything like that. There's a limit of $400 a year that you can exclude. You can give someone a gift for more than $400, but they can only exclude up to $400 unless you have a written plan. So some companies have a plan that says, look, on their 5th anniversary, you give everyone X. On the 10th anniversary, you give everyone Y. And so they've actually got a written program put together. If that's true, you can actually push an individual award up to as high as $1,600, but during the year, they still have to average no more than $400. So that means if you're giving away a $600 one, you better be giving away some cheap ones too, so that it averages out to only $400. So unemployment compensation, even though strangely you might think that's not taxable, is totally taxable. Social Security benefits are taxable based on need. So there's a needs-based calculation that's done that determines whether you pay 0% tax, 50% tax, or 80% tax on your Social Security benefits. This is, you calculate a modified adjusted income. You add some things back, you deduct some things, then you throw it up against these rate tables, 0, 50, or 80. That brings us to the end of Chapter 4.